be dealing with extensively during the short presentation, keeping in mind the fact that the laws are potentially going to be changing. Understand, up until about 3 weeks ago, if somebody would have asked me if there are going to be any corporate or individual tax changes in the United States, I would have said the chances are very, very low. I think because of the political environment, and in particular the concerns that the Republicans have for the elections in 18 at both the state level and the federal level for the House and Senate, that they need to show that they've done something. Obamacare has not been successful, so consequently, at least the repeal, they're trying to focus in on the tax side. Also, most importantly, from a legislative procedural perspective, there was a very significant change, and that was that recently the Senate, which has the smallest majority where the Republicans have a few votes of a cushion over the Democrats, what used to be the requirement that you had 60 votes to pass a tax bill in the Senate, they have now, which would have been a supermajority, they've now reduced it. So all you need is a simple majority, i.e. 50 votes. And understand in the Senate, if there is a tie, which is always potential, then the vice president would vote. So it's something that has a lot of vitality, and again, on the House side, there's a significant margin of the Republicans over the Democrats. So keep this in mind. Okay, why is it important to understand it? Effective tax planning. You have to understand at the same time when you're dealing with multi-jurisdictional inbound, outbound transaction, and in particular here we'll be focusing more on the inbound going from Israel to the United States, the different jurisdictional issues, and in particular some of the treaty overlays. Number 4 would be the possible new tax laws in 18. Number 5, most importantly, this past July, and it all happened very quickly, the United States Tax Court reversed a very important rule. In 1991, the Internal Revenue Service issued a revenue ruling that basically said that when you sell, if you have foreigners that have an interest in an LLC, and the LLC underlying assets are non-real estate based, then that's deemed as though, in essence, it's a sale of assets, and therefore it's going to be subject to U.S. taxation. All of a sudden, in the Grecian magnesit mining case, sorry about that, let's try saying that 3 times fast. Okay, we'll call it the Grecian case. What happened is that the United States Tax Court decided that that revenue ruling is not correct, and you have to do it and really uphold the entity approach. And consequently, the sale of an LLC by a foreigner will not, if it's unrelated to real estate, will not directly subjected to U.S. taxation. Therefore, if you have, for example, Israeli residents, okay, clearly they have nothing to do with the United States, not subject to U.S. taxation, and therefore subject solely to Israeli taxation. If alternatively you actually have those that are duals that live in Israel, then you have at least more of an argument to say Israel gets the first bite, which makes a huge difference from a structuring perspective, as well as, and most recently we were able to use this in a transaction. The problem is that it may change. And one of the things we'll briefly talk about is the Senate bill snuck in a repeal of the United States Tax Court's decision, which would then basically bring everything back. Now, we have to be careful about that. Transition rules, what about those transactions that already occurred? So, keep this in mind. Of course, you've got to keep in mind the characterization of the income. What is it? Is it ordinary income? Is it all structured by virtue of contractuals? You've got dividends coming back. Is it royalties, licensing? Stay tuned. Of course, foreign tax credits are near and dear to everybody's heart, and who gets the first bite? Now, understand from a state corporate level income tax perspective, 45 out of 50 states have a corporate level income tax. Remember, in the earlier presentation, we focused primarily on the sales tax side. This is on the income tax side. Okay, North Carolina being the lowest, and we've got Iowa being 12%. 7 states, including Alaska, Connecticut, DC, Iowa, Minnesota, New Jersey, and Pennsylvania, have at least 9% rates. 7 states are less than 5%. Now you're going to say to yourself, great, that's exactly where I want to be, at least from a state perspective, from a state tax perspective. But, query, how many are actually doing business in these states? Arizona, Colorado, Mississippi, North Carolina, North Dakota, South Carolina, and Utah. Why is that the situation? Because that's what's been successful in facilitating those states, and they have other ways of getting revenue. In contrast, understand, keep this in mind, that not all states have a corporate level income tax. Some impose a gross receipts tax. Basically, whatever your gross receipts are, they impose a tax on it. Those states are Nevada, Ohio, Texas, and Washington. Keep in mind that that's neither South Dakota nor Wyoming impose a corporate level income tax nor gross receipts tax. For any of you that have actually been in Wyoming, it is one of the most gorgeous states. I actually happened to have gone out there to Jackson Hole. It's very interesting. In Jackson Hole, which is where the economists get together every year, and more than 90% of all of the real estate in that city is owned by the federal government. And therefore, because of such a small amount that's owned by individuals, a small postage stamp of a house is well in excess of $1 million because we don't have that many homes. So if you're looking to find a place, keep that in mind. Okay. That's just the same similar structure, chart we had before on the sales taxes on the corporate side, just again echoing it from each state's perspective. Now, comparison, just to keep the backdrop of all this. U.S. Israeli maximum corporate tax rates. You've got a different marginal sliding scale going up from 15 up to 35% in the U.S. Sometimes it's an extra tack on 3% for branch profit taxes. Israel, typically it is 24%, can be much higher because of the branch profit tax, and of course you have the preferential rates for those high-tech that are in the preferred enterprise. Sometimes it's 16%, sometimes 12%, sometimes it's even as low as 7.5%. However, brand new potential because of the tax bills that are pending. And by the way, ladies and gentlemen, if anybody wanted to bet today what actually is going to pass, okay, I would say that clearly those things that are that the Senate and the House are actually consistent with obviously have the far greater amount. Again, there's a lot of nuances. But at least as it relates to this area, okay, both the Senate and the House are effectually reducing the rate down to 20%. Now, it's very interesting because what happens is that, as you hear shortly, America is almost doing, as I shared with somebody this morning, it's almost pre-Purim planning. Now you're going to say to yourself, what in the world does Purim have to do with everything you use Hanukkah, let alone U.S. taxation? One of the themes of Purim is the Nahavachol, the exact opposite. In Israel, the focus most recently has been to get the cash, the earnings out of the companies and incentivize individual owners to take it as a dividend. Most recently, they reduced the rate by 5%. And a fair number of people took advantage of that and now have cash at the individual level. However, in the United States, as you'll hear shortly, it's very possible that we're doing the exact opposite because you are reducing the corporate rate to 20%. And as making it more of a territorial tax at the entity level, but at the individual level, it's going to still be taxed on worldwide income. Keep that thought in mind as we go forward. Okay, now, understand that when it comes to pass-throughs, because remember, such as LLCs, subchapter S's, remember you have restrictions, subchapter S's, including foreign shareholders. But what happens is the Senate is going to provide a 17.4% deduction for non-wage income and then it's going to be basically, it's not going to be available for service businesses except those where the taxable income is below a certain amount. One of the areas it will not allow this for is for lawyers, attorneys, and similar professionals. At the state level, it's going to do a little bit different. They're going to provide business owners to either count 70% of the income as wages, of course subject to the reduced, the individual tax rate, and 30% as business income at 25%, okay, or you do it as a ratio, and instead of having it as more of the 17.4% deduction, it's going to put it as a separate tax rate. So either way, it's going to be 9% for the first 75,000, or alternatively, it's going to be the ordinary rate of 12%. But the key thing is that they are reducing the rate for certain types of businesses. Keep that in mind as we go through some of the possibilities on the structuring side. Now, granted, ladies and gentlemen, why in the world does an Israeli company want to do business in the United States? Typically, the first thing they want to do is expand sales. R&D products developed in Israel, and now they're going to want to make a foray into the United States market, figuring the grasses are greener there. Again, you've dealt with the compliance like we talked about, potential sales tax issues. Okay, so now the question is that if you don't set up a separate U.S. entity, okay, and you're going to sell direct. So now the question is, ladies and gentlemen, am I subject to U.S. taxation at the individual level? Well, we said before, some states will require a physical presence. Some, it's all based upon a revenue basis. So what are you going to do? You're going to try to keep the revenue below a certain amount in each state? You can't necessarily control it. If it's single state based, okay, but these are things you're going to have to keep in mind. Now, is it smart, for example, to sell direct without having anything intervening between the two? Not necessarily, because you're exposing all of that income potentially to a lot of unnecessary state income taxation. And it may be because of the high-tech world that you're oftentimes dealing with California, which is a very high state income tax area, okay, let alone some of the other jurisdictions. So what do we do over here? Okay, and of course you have to be qualified to do business. So typically what ends up happening is the possibilities are LLCs, partnerships. You got a regular C Corp, okay? Can't be a flow-through, of course, if it's owned by foreign shareholders. And then we got this Grecian Magnesite case. So it'd be great. Assuming the Senate bill provision doesn't pass. So what do I have basically? I've got a general structure pursuant to which I've got an Israeli company. It forms an LLC, has nothing to do with real estate, and now what ends up happening is that I've got this opportunity after a while to sell out the LLC, hopefully everything at that level, when it goes back to the United States, to Israel, would not be subject to the U.S. taxation on the sale of the LLC. Now this just gives you an idea of how important it is. Let's say, for example, assuming this law stays in place, if in fact it turns out that you want to buy real estate, or you're going to buy the warehouse, the building, separate it into separate LLCs and keep them completely distinct. Okay, now, the question then becomes one is that, what's going to happen to this case? Can you rely on it? Let's forget about the Senate bill for a minute. Okay? IRS going to appeal it? Okay? Well, even before that, it's very possible that Congress will either pass a bill or alternatively issue or try to reissue regulations to reinstate the position. Now again, very quietly the Senate has snuck it in. Okay? By the way, just so you know, not only has the Senate snuck that aspect in, at least conceptually, because the actual language is only coming out as we speak, but in addition to which it's now been disclosed that the Senate bill is also backdooring the fact that trying to repeal the Obamacare. Now the question then becomes one is that are they not grabbing too much? You know, in Hebrew, the Aramaic expression is tafastim meruah lo tafastim. You grab too much, you don't grab anything. In America, you know, it's often described as pigs get fat and hogs get slaughtered. So I have the Senate group try to grab too much in this and use it then to unfortunately submarine its efforts. But we'll see. One of the key aspects of that will be is that the age-old issue that foreigners have with the non-credit ability to use the Obamacare tax, the 3.8% that you pay as a credit back in foreign tax credit purposes, may actually come off the table. Whether it's going to be successful or not, I've got reservations about that, but time will tell. Okay, so but in the meantime, there are a fair number of companies that have already begun relying on the Grecian case for purposes of structuring. Be careful in light of what may come down what might can be. However, that doesn't mean in terms of the current situation, but you have to weigh those risks. Okay. Now understand, because of the Grecian case, what happens is that, at least in the private equity, let's talk about that for a minute. Oftentimes, for example, you've got foreign companies that will make investments through through various foreign situations into the United States. Historically, what's been very, very popular, the flavor of the month or the flavor of the year has been using foreign blockers. Okay, and the reason being is because it basically uses this to invest in U.S. operating partnerships. It protects the foreign investors from recognizing ECI, effectively connected income to the United States, as well as certain tax-exempt investors. It may change now, and we may actually have many more U.S. blocker corporations as a way of doing that and keeping things subject to the exemption for under the Grecian case. Now, understand one thing is that because we've got this multiplicity of potential state income tax situations, you may want to have a structure pursuant to which you're now going to layer your structure with more than one LLC or more than one company per state or per type of business you're actually doing. For example, real estate as compared to non-real estate. However, you may want to have it so that from a state income tax and potential sales income tax perspective, you are doing a better job managing your structure and potential tax consequences. Okay? Now, what that means is as follows. Understand, with respect to keeping it simple, an Israeli parent in the U.S. sub, the maximum for current maximum U.S. corporate tax rate is 35%. If dividend to Israel, okay, under the treaty can come down to 12.5%, but that's still, ladies and gentlemen, 37.5%. Not a small amount, but if you don't get the treaty qualifications, it's as much as 25%. And of course, you got the federal and the state. So what are we going to do? So basically, what ends up happening is that to help reduce the state situation, many companies will set up in Delaware and Nevada. That's primarily because of corporate level purposes, but also because of certain other advantages, especially on the tax side. But this is where we talked about before the alternative structures on the brother-sister. For example, Israeli parent, U.S. holding company, and I've got various LLCs, Alabama, California, Nevada, and Texas. Why do this? Containment. Number two is that it also gives you an opportunity to also make sure that you don't have unnecessarily exposed, not just on the income tax side, but there's a myriad of other rules, for example, labor, the wage and hour requirements of each state, and there can be other types of regulatory matters that you may unnecessarily open yourself out if I only have one company doing business in a multiplicity. Now you're going to say to myself, you're going to say to yourself, oh my gosh, I now have to hire, Philip, for example, and his group, not only to do one U.S. LLC, but to do a multiple amount. Well, in reality, the bottom line tax savings by using multiple numbers of LLCs per jurisdiction may far exceed, those benefits that you're going to derive may cause there to be an effective tax rate much, much lower than otherwise would be the case. We must analyze, yes, it does show an extra layer of administrative, cost and administrative attention to detail. But the fact remains is that still, as you're building out your infrastructure, it's something that has become much more popular. In addition to which, we're doing this extensively in the United States with different companies. Let's forget about the foreign side for a minute. We use this a lot because of the ability to pretty much control where we want to be taxed. And understanding the different thresholds and things of that sort, we can monitor and structure things appropriately. Now, the question really becomes, you have the tail wagging the dog, which is that what exactly is the bottom line goal? It's obviously to increase sales and increase the net effect of the after-tax cost. That has to be weighed in the whole global effect. Some of the other aspects of this, just to understand, just in terms of where we are on the pending tax legislation in the last few minutes of the presentation, is again, we talked about this. There are three major proposals for U.S. taxation. One, new territorial tax system, but understand that's at the entity level, not at the individual level. Number two, it's an opportunity to bring a huge amount of cash and those investments that are here that until now have been kept overseas back to the United States at a very low tax rate and anti-based erosion rules. Let's just briefly talk about that, at least what's being contemplated. 100% of the foreign source portion of dividends received by a U.S. corporation from a foreign corporation in which it owns at least a 10% stake would now come back basically tax-free. However, how long do you have to hold it? House bill says 6 months. Senate bill says you can't just have it now for 6 months, you actually have to have it for a year. We'll see how that turns out. But it's a huge, huge game changer in terms of strategy to bring more cash back to the United States. Number two, you've got special rules, again, under this territorial tax system for hybrid dividends. Senate bill will disallow it in a certain context if the dividend is deductible by the foreign corporation in computing its tax. So it doesn't work for all situations. And what's it effective for? A little bit different. The House bill has a the Senate bill has it basically for any tax bills, any years beginning after 12/31. The House has it for distributions, irrespective of when the tax year is. Special rules for sale of foreign corporations. Senate bill applies to the dividend exemption to the sale of foreign stock. Again, you've got to be careful because of the lower level EMPs. Terminating loss also for the sale of stock of that's a 10% owned. Again, you've got a reduction in the basis, and however, that's on the House side. The Senate bill will disallow that. Keep this in mind as you're going forward. Again, I would not bet the ranch on all of this yet, but at least it's something to keep in mind. Mandatory tax on deferred foreign earnings. Understand this. There is clearly a difference in the tax rate, but the concepts are the same. Bring home all of this foreign-based money. I mean, how much money does Google, Apple, and Microsoft keep offshore right now? They're talking about billions of dollars. So what's going to happen now is that it would allow a company under the Senate bill to bring it back at a 10% tax rate, and for non-cash holdings at 5%. House bill is an extra 4% for the cash holdings, up to 14%, and for the non-cash holdings, 7%. Now listen to this one. Talk about favoritism. The companies would have 8 years to pay, regardless of whether they plan to return that income to the U.S., and a special rule for the restriction on use of foreign tax credits. Okay? So, not a bad deal. You get 8 years to pay this. Is that an incentive to bring cash back? Okay? Now, by the way, bringing all this money back to the United States, is that going to mean that they're going to actually put it to work? Or they're just going to reinvest it as well, and continue to increase it? Okay, also, one of the hot buttons has been under Obama regime was the anti-inversion rule. It looks like the Senate bill may also be bringing that one back as well. Just real quick on the anti-base side, the base erosion rules under the House bill, the Senate bill has an incentive, talk about again favoritism, to basically enable a U.S. company to actually sell goods and services abroad and only be taxed at 12.5%. On the House bill, it's 20%. So again, there's symmetry, the only differential is the tax rate. Similarly, you've got a different rate as it relates to the net CFC income and special rules when it comes to definition of it. Now, here's something that's very interesting. There's an intangible property repatriation under the Senate bill who would be allowed to repatriate intangible property tax-free. And what also is coming to the forefront is that there's a special rule that was a little convoluted, but when you drill it all down to the Senate bill, there will basically be trying to incentivize tech patent-oriented IP companies so that they don't have their income sitting over in foreign entities, as for example in Ireland where the rate is 12.5%, but instead incentivize companies to bring back that income ongoing, not just what's been in the past, but prospectively at a rate of 12.5%. So basically putting a similar box approach to the United States taxation to enhance that tax in the United States as if it was going to be earned overseas and kept there. Again, favoritism, yes. Much more at the company level as opposed to the individual level. Okay, ultimately there's going to repeal some of the certain other tax on the investments in U.S. property, and however, and this is also a big game changer, which is that there are going to be some much needed changes in the carried interest rules. Okay, that's going to be limited by the House bill by tripling the length of time you have to keep it, and then it will still be qualified to the tax rate of 23.8%. Senate, we're still not sure exactly until we see the actual language. And now comes the coup de grace, which is the interest deductibility rules. Now let's just go very quickly through this, but at the same time understand what's pending. The Senate bill would restrict an interest deduction for businesses to 30% of its adjustable taxable income, while allowing interest that's not allowed as a deduction to be carried forward. So you don't lose it, it's just suspended. The House bill is going to preclude companies from deducting interest that exceeds 30%, and basically that's it, it's finished. Now what does it not apply to? It doesn't apply to real estate firms and small businesses. Special rules for certain kinds of inventories, car dealers, etc. So there's going to be a significant change potentially in the interest deductibility rules. Okay, so that brings to a close a brief overview. Understand the takeaways are, number one, you need to do aggressive and proactive planning at the state level in order to enhance your inbound business. Number two is there will be some very creative ways to take the money back to the United States. However, keep in mind the fact that it may be completely a change in the sense that some companies, although the Israeli government wants you to keep money over here, there may be a huge incentive to keep it in the United States, which may cause some companies that have Israeli parents and U.S. subs to think about having something reversed and doing some reverse triangular mergers in a tax-free mode, which is also potential, subject to what ultimately may be a significant tax benefit of having it subject like to the majority side in the United States as opposed to overseas. Now imagine if we pass all these laws and then comes the next presidential election and they change it. But let's wait to see what ends up happening. One other thing real key is that from an individual perspective, everybody's been asking, what about the repeal of the estate tax? Right now, the common theme between the Senate and the House is that it would be an immediate doubling of the credit from approximately 5.5 to approximately 11 million per person. The only big difference then becomes one of on the House bill, it gets repealed in 2024, and the Senate bill, it just continues out there. It's still subject to a maximum of 40%. That brings to a close the presentation. Hope you enjoyed it, and if you have questions, we'll have that at the end.
Thank you, Stuart. Coming attractions, we'll see what happens in the tax law. עכשיו נעבור לראש אמרתי ידיד נפש.